Today's show is brought to you by BCB Group. You're going to be hearing more about them later on in the show, but for now, let's get into today's interview with Juliette Declercq. Today, I'm joined by Juliette Declercq of JDI Research. Welcome, Juliette.
Thank you very much for having me on your show.
Juliette, we've got a lot to talk about. You've got some fantastic charts showing how your macro framework has changed from a disinflationary view to an inflationary view. And then, of course, we got to talk about some of the active macro trades that are going on with the turmoil in European markets due to everything with Russia and Ukraine. Before we get started, Julia, can you just tell us a little bit about your background and how you developed your macro framework and how your learning evolved over your career?
So my background is pretty much always in strategy, but starting at JP Morgan in '99, I was basically strategist for emerging markets. Then was given a macro book by the head of trading in New York, which I did for 3-4 years. Had great fun, but really my passion is going to find the information, going to find the underlying trends. And I found, lots of clients and friends over the years that are trading my views a lot better than I can do it myself, which basically has allowed me to, keep going with my passion, which is basically sort of like leveraging traders' brain by going to look for the information that they would want to be getting and look for themselves to basically add to their conviction. And what I'm really doing for clients is trying to decipher what is noise and what is the trend that we basically want to trade, and how we want to use the noise to actually benefit and make the noise an opportunity, a trading opportunity.
So you can use the signal to identify that the price should be here. The noise can drive it from here to here, and then you can buy. So the noise can help you. That's interesting. What do you see? So much turmoil going on in European markets. The Russian stock market is selling off extremely hard. The Russian ruble is at an all-time low. European markets selling off as well. Price of oil, Brent back over $100. What to you seems like a signal, and what to you seems like a noise?
I mean, that's a great question, because we basically adding to a macro backdrop that I find has undergone a complete paradigm shift over the crisis, and especially in Europe. We're adding to that geopolitical backdrop, which is undergoing a complete paradigm shift as well, and especially in Europe. I think it's not noise, because there won't be like going back to where we were before. I think it appears pretty clearly to me that Russia wants to basically undermine the post-World War II peace order, and that's really what's at stake here. I think what's at stake is really trying to undermine NATO and push as far as basically trying to see whether there is such thing as an Article 5, which is basically saying that if you attack a NATO member, you attack all members. And I think what really Russia is trying to show, that basically NATO is potentially like brain dead, which obviously does not appear to be the case when you're actually looking at what happened this weekend. I think what happened this weekend, on the back of the very strong Ukrainian resolve to fight back, and not that I had any doubt about that, but I think many geopolitical actors were probably looking for Russia to be a lot stronger than they've been, and that's basically waking up the whole Europe, NATO, and putting everything back into complete revamp of like geopolitics. In fact, we're basically creating a European geopolitical power. I mean, Germany is no longer pacifist. Sweden is no longer neutral. Europe, you're looking at like 7 years ago, we were talking about whether we're going to be bailing out a EU member, and we're basically now like delivering jet fighters to a neighbor that's been attacked. And we shouldn't even don't forget as well, even basically Switzerland has gone out of its neutral position to actually support the EU, UK, and US. He's basically freezing central bank, the Russian central bank's assets, which is really in terms of like monetary. In terms of monetary process, basically, it's like the nuclear option. We should really bear in mind that since the invasion of Crimea, it's been Russia's like main concern to basically bunkerize the economy, and part of that was obviously to amass enough reserves to be able to live potentially without exporting without exporting energy, and basically potentially deprive Europe of those obviously key exports. So that's basically the whole world has used the nuclear option on that, and we will see what happens. But what is clear is like basically a European nation has been has emerged out of COVID first. But the second thing is obviously geopolitical, and I don't think we will ever go back to sort of like have spreads blow up to sort of like levels we've seen before, because there is now like a union which has shown that it's got very strong resolve. I mean, I think EU what's mind blowing over the weekend is how fast and how far EU has moved. Even much faster than the UK, which was obviously, claiming that being out of the EU would allow them to be a lot more nimble, and that's not really been the case at all. So yeah, we're basically adding to a macro paradigm shift, a geopolitical paradigm shift. It's a move in both cases, which is obviously towards like a very unstable equilibrium, but that's the one we're going to have to get used to.
How many of those sanctions do you think will be felt within Europe by people in Germany, people in France? I know Germany is a huge importer of energy, and it really depends on natural gas and oil from Russia. Do you think that could have negative impacts on economic growth and to bear European stocks?
I mean, there's no question that the risk is obviously stagflation. And what you can see here is basically all the shocks, the supply shocks that have happened. So you've got the OPEC embargo in 1973. You've got the second oil crisis in 1979, Kuwait invasion. What's really started so far, my thesis has really been that commodities have been really strong, but it's not been a supply shock. It's been much more of a demand shock. In other words, we've exited the COVID crisis with a lot stronger demand. Demand was basically like deficient for the past 3 decades, and I think there is a paradigm shift, and we can discuss why I think that over the COVID crisis. But basically, what I believe was the case until January was that demand, global demand, completely justified the new trend in commodity prices. What might happen in going forward is that that demand shock, what actually started as a demand shock, turns into a supply shock, where basically commodity prices, energy prices are no longer in tune with global demand. In which case, we'll move away from basically inflation as a reflation trend to basically stagflation with the risk that basically higher price, trigger a recession. But I don't think, that's clearly the risk right now. And in terms of whether it's likely to happen, well, the problem today is Russia is still, exporting the gas. Russia is still exporting the oil. But if you basically see the fact that their assets are basically being frozen, then you might legitimately ask why you would keep basically selling energy if you actually can't access the assets on the back of that. So for me, that's really the key risk. Whether it will happen, we'll see. I don't think any geopolitical expert will be able to tell you, with any certainty. But that's really what's at stake here.
Yeah. So Julia, just to illustrate a few points, what we're seeing here on this chart in black is the Bloomberg Commodity Index, and when the economy is running hot, there's demand for commodities because it's an input to economic production. So when the price of commodities goes up, that can be one of two causes. Number one, demand, because the economy is running hot. And if that were the case, you would expect the ISM Manufacturing New Orders Index, which is in blue, to also rise. But what I believe you've highlighted in this chart is when the commodity index goes up, but the ISM Manufacturing Index did not go up. And in other words, it's not reflation, it's not growth, it's not demand. It's a supply shock. It is a supply-driven.
Exactly.
Can you explain the significance between, you already said that supply-driven shock can cause a recession. Why is that the case? And why is that different than a demand-driven?
Basically, there's two way inflation can affect consumption. In the end, what really matters is demand, right? So if you've got a shock of inflation, prices go up, purchasing power go down, everyone is feeling the squeeze, and you basically end up with a demand squeeze, and that's what I'm calling a supply shock. What we had so far post-crisis wasn't much of a supply shock. I think some argued it was in 2021, but with wages actually picking up as well, it looked less and less like a supply shock and more like a persistent inflation. So the first way inflation can work is basically you feeling much poorer. The second way, but the second way inflation can impact the macro outlook is by making you feeling a lot richer. And how does it work? Well, so what's happened post-COVID is as a reaction to higher prices, higher inflation, you actually have price expectations moving higher. And what's really interesting is that many Fed members have argued that long-term inflation expectations are actually anchored, and therefore we don't have to worry about wage price spiral. What I'm arguing here is that it's really the 1 year outlook that matters, and what we've seen everywhere in the world is actually inflation expectations actually trending higher. And even in the US, where the trends are much more advanced than in the rest of the world, we're continuing to make new high in 1 year inflation expectation. Now, why does it matter? Well, because the first effect of inflation is obviously higher price. It's contractionary, but when you actually have a labor force which has very strong bargaining power, what you can do about inflation is basically asking for a higher wage, and that's exactly what's happening. So the first shock, the first bout of inflation is like a shock on your purchasing power, but then if you get used to it and workers actually have a bargaining power, what happens is basically that inflation expectations actually turns into higher wages, and that in turns basically feeds what I'll call the nominal illusion, which basically says that whatever happens to inflation, you still feel richer if your wage is higher. And that really interestingly goes back to the actual reason why the Fed is pursuing like a 2% inflation target. So what happened in 1996 is you had Yellen on the FOMC, and at the time it was Greenspan that was the chairman. And there was like a whole argument about whether they should be pursuing a 2% target or 1% target, or why not like basically zero inflation. And really interestingly, Yellen actually argued that you need a little bit of inflation, and the reason for arguing for 2% was like the sort of like the greasing the will argument. So what is the greasing the will argument? Is she basically cited a survey from Yale economist Robert Shiller, who actually asked, surveyed everyone, everybody, and asked, what if your pay went up, would you feel more satisfaction in your job, more sense of fulfillment, and that even if prices went up just as much? And Yellen was like really, proud and excited to report that 28% fully agreed and 21% partially agreed. And there was only 27% which completely disagreed. So what the survey is telling you is basically, I give you 10% nominal increase in your wage, and I increase price by like 10% as well, and you're gonna feel better. So you might as well like basically have a little bit of inflation, and that's the greasing the will argument. What's really funny is in a way, is that the Fed at the time, Yellen also added at the time that in that actual survey, no economist went for being more satisfied, and everybody had a good giggle in the room. What I want to say here is really that inflation is a very strong economic stimulant when the everyman in the street, which is actually driving macro trends, think that inflation will be persistent. So there's few reasons for that. Firstly is obviously you're getting nominal increase. You might only find out later that it buys you less of your normal goods purchase. The second thing is obviously when there is inflation, inventories are actually higher. Inventories is actually a plus. It costs less. It costs much less to have high inventories when there is inflation. And the same thing for hiring as well. You basically want to hoard everything and front load your consumption when you actually believe that inflation trends will continue. So that's one macro trend that we haven't really been talking much because the last time we had anywhere close to wage price parallel that we have right now was in the 70s and 80s.
So you said there are three reasons why rising inflation expectations can actually help growth. The third one makes sense to me, but you want to hoard things. If I think the price of milk is going to be 10% more expensive next month, I want to buy a lot of milk now. I don't want to buy a lot of milk next month. Could you walk through the first two? I don't know if I fully understood those. And then
inventories, for example. Inventories, just if you're like a company, obviously, you want to hoard as much inventory as possible, which, we've never seen in the past 30 years. Everybody was like trying to cut inventories and basically like go to like just in time sort of like supply cycle. But in an environment where prices are going to go up, you want much more inventories because it's actually going to make you money.
Okay. Why is it going to make you money?
Well, because you buy you buy your inventory at like a 10% discount to where it's going to be in 12 months, right? You buy your commodities, you buy all your supplies. All your supplies are going to be like, if there's 10% inflation, you want to buy everything today, sell it later, but you obviously paid it a lot less today.
Yes. Okay, that makes sense. It's like the corporate version of consumers wanting to buy milk now, except they want to buy their parts, their commodities now. Okay, and then what's number one?
And it's the same thing for like employees as well. If you're worried you're not going to be able to hire employees, firstly, you're not going to fire anyone. And secondly, you might hire a lot more people and maybe make them work a little bit less, but to basically like have the luxury of being able to expand when you feel like you're going to need to expand. When you're in an inflationary environment, you basically want to hoard everything. You want to hoard commodities, you want to hoard supply, you want to be hoarding employees, and also that's basically on the back of like the flip side is basically that the consumer wants to basically front load consumption as well. But there's another side as so at the top in the dark green line. So top at dark green line, you can see that in 5-year nominal yields, we're now back to I don't know. I updated that chart this morning. We were like a bit above 180, so that's about the same level as we were pre-crisis. But if you're looking in real terms, which is the green line at the bottom, you can see that we're still a lot more, we're still a lot lower, like about 140 basis points below like 2019 levels. And that, of course, is the effect that it will have on when you're borrowing. You're not borrowing at 185%, you're actually borrowing at minus 130 basis points. And that's obviously the last reason why inflation is such a stimulant, because obviously even if it makes the debt disappear at the sovereign level, and I think everybody knows about that. You're talking about completely different game. And to go back to Europe, it's also the reason why I'm like so positive on Europe is that, pre-crisis, you had, let's say you were looking at debt to GDP ratio in Italy or Greece, and you had maybe like, at best like 1% inflation and maybe like 1% real growth, and that's basically like 2% nominal GDP growth, which is, with 2% nominal GDP growth, it's really difficult for your debt to GDP ratio to actually improve. If you've got if suddenly you've got like 4% nominal growth and like 4% inflation and say like 1.5, 2% real growth, then you're talking about like potentially like 6% nominal growth per year. Your debt to GDP ratio like will basically improve on its own. And that's true for countries. It's obviously true for corporates, but it's also true for you and me. If you can borrow at like deeply negative real yields, you will be basically richer by design next year and the year after, if you believe that whatever you're buying is going up.
Juliette, this chart is fantastic, and I want to dig into it. But before we do, could you sort of just zoom out and describe when you say a macro paradigm shift? Is it what you're talking about, inflation? Is it when you're talking about reflation? And also, why now? What was the cause of this paradigm shift?
I think for the past 30 years, there's been really, certainly in like a macro world, there's like a very entrenched belief that the reason for low yields and low growth potential, low real yields, equilibrium yields and growth potential is basically demographics. So, we used to, for example, if you take the US, we used to be growing in the labor force above, say, like way above 2% in the 2000s, and we're basically going to be converging to just above zero in the mid 25s, and that there's a very strong belief that that's the reason why yields have collapsed, and so we haven't moved away from that macro shift, and basically COVID happened, and we're just going to go back to those kind of like really detrimental and trends of like weak demographics and therefore weak and therefore like low and potentially negative real yields. Now, what's really interesting is there was like a research piece that was actually presented in August last year at Jackson Hole, And the piece is called What Explains the Decline in R star? Rising Income Inequality versus Demographic Shift.
So our story is that's the natural rate of interest, right?
Yeah, R star is the equilibrium real yield. Real yield.
Okay.
Yeah. So what is driving the very low R star, like real equilibrium yields? Is it weak demographics or is it inequalities? And what the report actually showed is that inequalities explain a lot, a much bigger part of like why potential growth has come down in the past 3 decades. And if you're actually looking at Kansas City Fed estimate, basically high income households save about like 3 to 3.5 percentage points more of the national income than before 1980. And that's really the key. If all the income, if basically a growing part of income is going to households that are not going to spend it, you've got a massive issue with of deficient demand. And
yeah, they're not going to the store and buying chips. They're
exactly
investing it in bonds or savings accounts that earn 1% or less. So it's inherently disinflationary. And those cohorts are the wealthier cohorts who their marginal propensity to spend, a fancy way of saying how much money do they spend, is quite low. If they, for every $1,000 they get, they may only, I'm just making numbers up, they may only spend 400 of it, and $600 of it goes in the bank. Whereas for folks who are on the lower income spectrum, they spend all of their money, in some cases more than all of their money.
Exactly. So the issue is like the second chart of my chart pack, which is showing non-farm real compensation per hour in light blue, and non-farm business productivity in dark blue. And what you can see here is basically that wages and compensation have diverged from productivity for the past 30 years, and that's really the main issue with demand. Now, why am I saying that? If you go back to the first page, you can see that it's unprecedented, but basically wages are exploding at the low income end, and not really going anywhere at the high end, and that's got a massive impact on basically aggregate demand, and I really believe that's a paradigm change, which is brought by the fact that I think in the past 3 years, and certainly over the crisis, money has been coming so easily, whether it's with crypto or tech stocks or any stocks. To be honest, you could basically buy anything in the past 2 years.
This episode is brought to you by BCB Group, Europe's leading provider of crypto-friendly business banking for institutions in the crypto space. They also provide trading services allowing you to trade FX and cryptocurrency quickly and at scale. They specialize in efficient execution of large orders in illiquid markets. So if you are an institution looking to make high volume trades, you need to check out BCB Group, because a great trade idea is worth nothing if you can't execute it. And that is exactly what BCB Group helps you to do. Their mission is to empower the global financial revolution through sustainable and innovative banking. Really glad to have them as a sponsor. So if you want to take control of your digital assets, please check them out at bcbgroup.com/Jack. That's bcbgroup.com/Jack. Thank you, and let's get back to the show.
So I think there's really the increased bargaining power in the labor force is not just the fact that there is a supply squeeze due to people wanting to stay at home because of health concerns or whatever. I think there is really this realization that yes, I still want to work, but not at any price. And obviously, it's helping that when you've got really strong demand, there's a need for a much larger number of workers which has basically allowed the lower end jobs to really explode in terms of like real wages. Some will be saying like, okay, they got a wage increase in nominal terms, but not in real terms. Actually, that's not true. If you're looking at US real hourly wage over the crisis, we're still growing on trend, but the lower end jobs in real term over the crisis, which is basically leisure and hospitality, that's actually gone up almost 7% in real terms over the crisis. So we're not talking small numbers here, and we are, potentially talking about a move that is not just happening over the crisis, but that will basically keep sort of like making potentially like productivity wages reconverge or somewhat reconverge to the level of productivity, which means that in the end, aggregate income is going to be consuming a lot more, and you're sort of like getting rid of one problem in terms of demand efficiency.
Yeah, I think we should note that this is real wages, but it doesn't take into account the labor supply or the unemployment rate. So like you see a spike in leisure and hospitality earnings in March of 2020. Obviously, that was not a good time to be. A lot of workers lost their jobs, but the ones who kept them were paid more. But now that it's adjusted, and now that the work is the unemployment rate is back to low levels. Yeah, absolutely. So Juliette, a lot of people will say, sure, wages are going up, but inflation is rising higher than wages. So it's actually destroying demand. Real income is going down. You have a retort to that I think is really interesting. Can you tell us a little bit about what we're seeing on this chart?
So, I mean, that's another way of saying exactly the same thing I was saying before, is basically, yes, there is on aggregate less real income, and you can see that in dark blue, real income has started dipping below trend, but real spending is actually still keeping on trend because of these like moves, which we could call like internal moves, where basically if you're moving more of income and wealth towards the poorer cohort, then you're going to get much more spending out of the same income.
Because of their lower marginal propensity to spend. Juliette, how sustainable do you think that this reflationary impulse will be? There are some who say you had a fiscal sugar rush in 2020 and 2021, but now that fiscal support is being removed, you're going to have a fiscal crash, and that spending will decline. I take it that you're not very convinced by this argument. Why is that?
Well, I mean, for me, really, the one chart to look at is the inflation expectations chart. As long as we're not starting to dip lower on that, I don't see any reason why we're not going to keep like spiraling higher in terms of like nominal illusion is feeding nominal consumption, and you're basically like getting higher rates on the back of that and higher inflation. What's really key here, and another reason why we have reached a paradigm shift, is because it's not only happening in the US. You can see on my chart on page 14 that it's also happening in the EU. It's happening in UK, and amazingly enough, it is also happening in Japan. So in EU, UK, and Japan, we haven't really seen yet the effect on higher wages, but trust me, there is like strikes going on. Whether you're looking at in UK, there's like a tube strike. There is strikes in France to ask for higher wages, and I've got no question in my mind that we will see the same sort of like wage higher prices turning into higher wages in Europe as well. And again, obviously, that assumes that the Ukraine versus Russia situation doesn't sort of like create a supply shock that basically just kills demand, heads into recession, and means that we're basically getting stagflation instead of like the reflation trends that I'm looking at right now. Well, that I was looking at before the crisis anyway. Yeah.
So just to be clear, when someone has prices go up around them, they have two choices. They can either consume less, so spend less money, or they can earn more in income and ask their boss for more income, or change jobs to have a higher salary. Just to be clear, could you flesh out why you think workers will be able to do that? Because workers always want more money, right? Like, what is it specifically about this environment that you think will allow sort of wageflation to continue?
Well, firstly, I mean, workers always want more money, but they've never had such great arguments. On one side, there's obviously like according to countries, basically 5 to 7% inflation, which is here for everyone to see. And on the other side, there is pretty much full employment wherever you look, right? Whether you look in US, EU, UK. I don't think we are at full employment, but we're nearer, and clearly labor market's very hot.
Can you talk to us about China? I know that the Chinese credit impulse, maybe you could explain what that is. It went down sharply in summer of 2021, but since then it's gone back up, and that gives you and a lot of people hope for reflation. What is the Chinese credit impulse, and what does it signal to you? Take a look at this chart.
So credit impulse in each region. So I look at it in Europe, in US. The US one is great because you actually get you can actually calculate it every Friday evening out of Fed data. The Chinese one is only updated monthly. And the same for like the ECB one. Yeah, I really like this aggregate here, and you can see in the US it's really interesting that so I've got here like credit card and other revolving loans, which is basically as high as it's ever been. The overall credit impulse. And I'm looking always at like 6 months one, which is more of a leading indicator and goes obviously faster than the 1 year one. So what you're seeing in the US is because obviously demand is not only the income you're making, and so basically, how do I define demand? We've been talking a lot about like whether demand is deficient or whether we're in the reflationary curve, and demand is basically the increase in the workforce plus the real increase in wages, but also how much you're going to be leveraging that demand, right? If I give you 100 and I give you like a raise, so let's say you're getting 110, and you actually really strongly believe that inflation is going to be 15% this year, then nothing prevents you from like leveraging your income and basically go and borrow whatever, like you might get, according to whatever country, you might manage to like borrow like 100 or like between 50 and 100. So the credit impulse is basically complementing the picture you're getting from the demand side, but by telling you a lot more about animal spirits and how much the consumer actually is prepared to leverage his income or not. And what you can see over the crisis is that obviously, the credit impulse has peaked in the US, but we're still basically at levels that's been unseen for the past few decades, and we're actually stabilizing for now at this level, at very strong level, which is telling me that the animal spirit is intact. It's really interesting because it leads consumption. It's a very strong leading indicator of consumption with about like 6 months leading. It's a similar thing in China. So what I've got on chart 9 is basically the 6 months credit impulse in China, and obviously because China has been such a big part of global manufacturing. It's very strongly correlated with like global PMI manufacturing. Obviously, it's better to take out China here, but basically China is like the global manufacturing engine, and when you're seeing leverage up, you basically sort of know that that China is going to turn from being a cyclical headwind, headwind in 2021 to basically become a very strong tailwind in 2022. So for me, that's like in terms of like the macro paradigm shift between like 2021 and 2022. There's first the fact that we are kicking in a sort of like price wage price spiral, and that's not only in the US, it's happening everywhere in the world, and that's really important. The sort of like synchronized move means that, you know, basically the Fed will be able to hike without shooting itself in the foot by basically strengthening the dollar, and in turn basically shrinking the global monetary base. You know, the stronger dollar means like equally an equal shrinking in the global monetary base. So it's really interesting here that we've had such a pickup, you know, and that really happened in like 3 months. We were still like basically deeply negative in terms of like the credit impulse in China. But obviously, you know, from December, there was really this move like with Chinese monetary authority to really like promote credit again. And that's basically how we turn from like a deeply negative credit impulse to like a quite, you know, strongly positive credit impulse, which is basically telling us that you know, the risk of China being a major break, especially to the manufacturing world, has dramatically diminished, and in fact the opposite could happen.
Julia, I'm really glad you brought up, because inflation and growth will be robust. That gives a lot of room for the Fed to tighten monetary conditions, to raise rates without causing recession. Really interesting that you say that, Juliette, because I know you noted in your work that you actually don't think the Federal Reserve will hike as much as the market currently thinks. I don't know exactly how many hikes are hiked in for the terminal rate, you know, somewhere between 7 and 8. But do you think that they will get that high? And also, you know, how many do you think they will get to in 2022? And if you think that, may I ask why? Because, you know, the Fed can hike, as you just said. They have a lot of room. Why won't they take advantage of that?
So firstly, I think we need to be a bit more precise, because I do think that we can price in more hikes, just not upfront. So I think so my recommendation is to basically pay 5 year rather than just you know, looking at a front loading of hikes that would, you know, potentially mean that you know, you basically kill the golden egg too early. So the reason why I think the Fed will be, you know, cautious this year, and, you know, certainly a lot more cautious than, you know, when we basically went as far as pricing 175 base points this year, is I mean, there's a lot of reason for that. I think firstly, I think the Fed wrongly believes that long-term inflation expectations are still anchored, and because, you know, they're more looking at like 5 year, 10 year, which indeed has not broken up yet. But I think it's wrong. It's the wrong aggregate to look at, because I think what really will be driving the wage price spiral is 1 year inflation expectations, and they are still moving up and actually trending higher. There is like a huge negative base effects that are coming in from, you know, in the next couple of months, and I think that will buy the Fed time in terms of like you know, continuing with incremental like 25 base point steps rather than sort of like going 50 and 50s. Another really important thing that we haven't touched base about is the flattening, the bear flattening of the curve. And that really reverts to the first thing we were discussing, which is what is driving, what is the underlying macro trend? Is it just weak demographics, or is there like something that, you know, that is telling us that our star, so the real equilibrium yield, is going to be potentially much higher in the short to medium term, and that would be on the back of lower inequalities and basically like stronger wages, especially at the low end of the wage cohort. Well, I think that dichotomy between long end yields being like really anchored by weak demographics, and let's say let's say we go back to pre-crisis level of like real yields that takes us basically, which was basically zero to like 50 basis point. So it tells you like long end yields can't go a lot higher than 2.5%. The problem is in the short term, I think it's possible that the real equilibrium yield is a lot higher, potentially 75 to 1%, which is telling you that you will not get to restrictive level before, say, like 3% at the front end. Now, the problem is if you actually hike to 3% into an economy which is in the long run sort of like as a real yield of like 2%, you will invert the curve. And I think that's really something that the Fed will want to avoid, because if you invert the curve, then you might actually shoot yourself in. It could actually become like a recession can become self-fulfilling. Banks will be lending a lot more. You'll constrain credit, and in the end, basically, like have a larger effect on demand than you might want to have. So I don't actually think that the flattening of the curve is telling us anything more this cycle than the fact that basically front-end R-star is a lot higher than it's been in the past, with a long-term R-star which is still basically like anchored because of weak demographics. Which means that the Fed will be, hesitant to get to the level that becomes actually restrictive to the economy, which basically means that they're behind the curve. They stay behind the curve a lot longer than what markets currently believe. Is that making sense?
Yeah, so I think so. The yield curve is a curve. It has the yields on one and then the maturity on the x-axis.
Yeah.
And typically you have a spread like the 10-year minus the 2-year, the 210 spread. When that decreases, as it has been over the past year, I think it's now at something like 40 basis points. It gets very close to inversion. And yield curve flattening typically is something of an ominous sign. And yield curve inversion, an inversion curve, a lot of people say predicts a recession. We saw one in the spring of 2018. So yeah. Why exactly is a yield curve flattening not ominous?
I don't think anybody believes that the reflation story is is there to stay for the very long run. But you still need rates to become restrictive if you want to slow demand enough that you actually kill that wage price spiral, which is currently ongoing. So another thing on on the curve is that I don't think a flattening is ominous in itself. Yes, inversion is basically when you're starting to price that the Fed will need to cut rates, and that tends to, in fact, that almost always leads to recession. Or let's put it this way: recession is always like preceded by like an inversion on the curve, but the opposite is not necessarily true. But yeah, the thing is as long as you don't have an inversion, all the curve flattening is telling you is that you're pricing hikes, and not a lot more than that. And as long as the curve is not inverted, it means basically the economy is able to weather those hikes. So I mean, for me, that's not an ominous sign. It's basically a sign of like going back to neutral.
Interesting. Juliette, do you think that the situation in Ukraine and Russia, do you think that could delay the European Central Bank, the ECB's plans to hike rates and then even perhaps do quantitative tightening?
I mean, definitely it will delay. I think the ECB is very, focused on the fact that inflation in Europe has been much more supply driven than is the case in the US. If I had to give you like an estimate, I would say probably 80% inflation in the US is demand driven, I think in Europe, you only have like budding sort of like reflationary cycle where wages are just starting to increase. So I think there's basically 80% of inflation is supply driven. So if you're starting to hike into inflationary cycle, which is supply driven, you run a very high risk of basically, pushing the economy to stagflation. And in the end, you're going to get rid of inflation, but you're also going to get rid of growth. So I think that the ECB is very keen to avoid this, and I don't see the ECB like normalizing in a shock, in a supply shock, an energy supply shock. And I think they've already been saying like. Even before Russia decided to declare war on Ukraine, the ECB was already keen to really allow like the green transition to happen without basically standing in the middle and killing demand on the back of basically like higher energy prices in the short to medium term that will allow a move to basically like being self-sufficient with clean energy.
Juliette, commodity price inflation, the price of commodities going up, has just been front and center since fall of 2020. A lot of analysts expect it to not continue. They think that the bloom is off the rose. What's your outlook on commodity prices? How is that informed by your reflationary view? And then, how high do you think things could get with a lot of these commodities that Russia produces a lot of that perhaps will no longer be able to enter Europe?
Yeah, I mean, long paid rates and long commodities has been like my central recommendations. Luckily, it's sort of like being emphasized by the crisis, because you're basically adding to a strong demand backdrop and central banks that are still very much behind the curve. And obviously here I'm talking mainly about the Fed, which means that you don't kill demand enough to actually rein in commodity prices. So the supply side, the supply shock is really just adding to these trends. And I don't see the Fed really being too shy. I mean, I think if the current crisis like continues, I don't think there is a chance that the Fed will go like 50 basis point in March, but it probably still will do 25 basis point. Because I think the Fed is cognizant of the fact that U.S. demand is extremely strong and spiraling via higher wages, which means that commodity prices can stay very strong globally. And obviously, what's adding to that view as well is the fact that China, which is one of the main consumer of commodities, is also obviously pushing the accelerator as well. So you've got basically a world which is synchronized in terms of demand. And I really struggle to see in a world that is demand synchronized, how you're actually going to get commodities to turn down, given all central banks are still very far behind the curve.
Yeah, that makes sense. If you have a reflationary view, pretty hard for commodities to perform poorly. Juliette, what's your impact on the broader equity market?
My A trades really is just basically higher nominals, stronger commodities, and I want to start to pick some value in European equities. But obviously, bear in mind the massive uncertainty around not just macro but also geopolitical. What I mean by massive uncertainty in macro is that obviously when you're relying on inflation and animal spirits, it can go all one way or all the other. And something like a war can obviously destroy reflation as quickly as it's actually happened, which is basically the last 3-4 months. So we have to be cognizant of the fact that we are in very unstable equilibrium. And so I like to stay with what's more liquid as well. I wouldn't even talk about Russia.
So you said it's a time of immense macro uncertainty. Those are the times that often assets like gold do well. what's your outlook on gold at this juncture, as well as perhaps cryptocurrencies such as Bitcoin and Ethereum, the latter of which I know you've been following a little bit.
Yeah, I mean, crypto, you know what? We have like capital controls in Russia. I would be, if crypto doesn't pick up a bit this week, then I'm going to be really worried about the asset class. In terms of gold, I've been looking for, reason for gold to break higher recently was obviously like geopolitics, but also the fact that the Fed is sort of like losing out on inflation and the inflation narrative, right? The fact that basically the Fed's losing control of inflation is a positive for gold. But at the moment, I would be really careful because obviously, the CBR, the Central Bank of Russia's asset have been frozen, and the only assets they can still trade is basically like China's yuan and gold, which is a large part of their reserve. So I'd be really worried this week about trading just macro. I think you could see like complete dislocations on the back of when gold, when it's the only asset you've got left to sell, what can happen. So personally, I wouldn't touch gold here. And I really hope that crypto catches a bid, because if crypto doesn't catch a bid in the middle of like basically like capital controls, and it's really the time where it's sort of like should be becoming useful, then I think we have to worry.
That's an interesting take, Juliette. It's been fantastic having you on Forward Guidance. If you had to sort of summarize your views for our audience before you leave, or a parting word you want to leave our audience with, what would you have to say?
I mean, at this point, be extremely careful. Again, like, we can, this week, it's not about trading macro. It's about trading dislocations. It's about trading, forced selling or forced buying of assets. We could get into times where nothing makes any sense anymore. So I'd really emphasize the fact that if you want to trade your sort of like medium term, long term view, don't go with leverage, which is what I'm currently doing. I do like to use the ongoing noise to basically like trade assets that I really want to own in the sort of like medium term, which is, I like to pick up value in Europe. The rest is obviously not something that we're going to get massive opportunities in, but I do like buying commodities. And I think, the last sort of obvious, but again, like quite risky, obvious trade that I like is basically to sell 5-year bonds. So looking for like higher nominal yields. And I think what's interesting here is that obviously, the noise and the war can actually, lower the front end, the number of hikes that are going to be delivered at the front end. But I don't think it will really mess up with where we're going to go eventually. And I think I can see like a strong. I have strong conviction in the fact that 5 years is going at least to 2.5%.
Wow, Juliette, I really like your analysis. Extremely sophisticated research and charts. It's been great having you on Forward Guidance. Do you want to just quickly just tell some viewers, about sort of JDI Research and also who your sort of client base is? I take it, given this is very sophisticated, it's not your typical retail investor, right?
No, I mean, I've got a few family offices, few high net worths as clients, but really the bulk of my customers are, institutionals, whether banks, real money, hedge funds, and I've got like 2 tier, which is basically one tier is basically getting everything right, which is like JDI comprehensive, and a second tier where you basically get to speak to me every day. You like it, you don't, but that's basically the premium, the premium subscription, which is basically mostly institutional as well.
Oh, very exclusive. So that's why I feel very lucky that we were able to get you on and share your analysis. Juliette, thank you so much. Thank you everyone for watching. You can follow Juliette's work out on Twitter at Juliette JDI. Thanks so much.
Thank you very much.